It's very common that very soon after people understand that they can buy existing companies, they quickly realize that there's an inherent risk involved with buying a business, right? So today I want to talk about identifying risk, managing risk, and how to think about it in terms of business acquisition. My name is Walker Dybel. I am the Wall Street Journal bestselling author of Buy Then Build and creator of the Acquisition Lab. Typically, okay, here's the thing. Risk is invisible. At the end of the day, you usually can't see it, okay? And if you take risk on, all right, the concept is that you're wanting to get an outsized return, right? Or at least like some kind of margin of safety for, the risk that you're taking, okay? And when you are making an outsized investment or taking on whatever this, this leverage or this risk or whatever it is, you're doing it because of the benefits of taking that risk on, right? And the thing is that when you take on risk is actually invisible most of the time. And what happens is that there's a multitude of outcomes and you have no idea what it's gonna be. And so if two people take the same risk on and one of them has, an external tailwind in that space and does exceptionally well, the risk was always invisible and that person is perceived as a genius. On the other side, if the same risk is taken on and there's external external volatility, what happens is that person can kind of get exposed that they took on this risk and maybe the outcome is less desirable, okay? So it was Warren Buffett who said, when the tide goes out, you can see everyone who's swimming naked. In other words, the whole time it's invisible, but then when the tide goes out, maybe this person wasn't taking as much risk on, maybe this person, mismanaged something. So this is sort of the point, is how do we think about risk in terms of when we do business acquisition? So again, risk plus volatility equals disaster. Risk plus tailwind equals genius, all right? So when we're thinking about taking on risk, we're sort of evaluating an opportunity, for example, in terms of what might happen, okay? And usually, if you're familiar with the bell curve, okay, this is sort of, 80% of outcome happens within one standard deviation of average. And so when we go into anything that we're doing, we're usually thinking, okay, I'm gonna base this off of what is probably going to happen in terms of the near to midterm future. And we understand that there might be some deviation off of that, right? We might say, well, things may go extremely well, things may go extremely poor, okay? But there's this sort of deviation that we can expect of how the external markets are going to or the external economy, whatever you want to say, the external world that we have no control of is going to kind of act, okay? And it's usually in here, all right? And when we take on risk and we stay in this range, things are typically awesome. However, every once in a while, outliers occur, okay? And so, there might be a really good time that might happen, or there might be a really bad time that happens, okay? And this is when things start to not go great. And every once in a while, okay, there's sort of like a black swan event, or like a once in a century sort of event, right? Like something that's just totally terrible. The same is also true, but it's usually in terms of bubbles, okay? Which in terms of risk, when things are a bubble, there's usually a drawback, right? A correction later on. So this is how we like to think about risk when we're going into it, knowing that when we take on risk, okay, and there's no volatility or things go as expected, we're a genius. And when things sort of go down here, okay, we are in disaster, okay, is what this deal is. Now, what I want you to understand is that if we approach life trying to make sure that we're going to protect ourselves from things that aren't happening most of the time, okay, how do I say? You will finish last, okay? You don't add as much value. You don't have as much impact. You don't build as much wealth. You don't have as much fun because you're always living in fear, okay? At the same time, up here, you know where I'm going with this? This is where greed exists, okay? This is where we get greedy. And it's like, okay, my friend sold his business for 100 million, and so I want to sell for 100 million or whatever. And companies can sell for 100 million normally, but I'm just giving a ridiculous example. So this is the landscape of how we think about what it is we're getting into, and when how the external market will impact what it is that the sort of outcome of the risk that we're taking on, right? And a lot of entrepreneurs, the things that we do is that it's usually by taking risks that other people are too timid to make or won't make that are the things that lead to the outcomes that we want as entrepreneurs, right? And I've just seen that over and over and over. I've probably been around entrepreneurship since the late 90s. And so ever since that time, that's what I see over and over. So here's the trick and how I want you to think about controlling risk, okay, and how this impacts us. So the very first thing, the very fundamental thing, okay, of everything that we do, the very fundamental thing of everything we do is you need to add value, okay? Add value. Okay? This is the core of all the activities that you need to be doing, okay? I don't care if it's a job, if it's, whatever you're putting your back into, okay? A high paid skill set, whatever that might be. The next thing we're going to add on top of this is I want you to expand the value you're adding through leverage, okay? Forgive me, I'm not up on who said it, but give me a lever big enough and I will move the world, right? So in other words, what leverage does is it allows you to create value at a bigger scale than what you're able to do just on your own, okay? Now, leverage is not just debt, okay? And let's define debt a little bit more macro. We're going to call it other people's money. Okay, other people's money could be investors. Other people's money could be bank debt, senior debt, and so that it could be even other people's equity. So we're gonna say other people's time. Okay, so you hire an assistant, you start to hire employees as you grow your business, and you're leveraging other people's time. Okay, and then I'm also going to throw in here other people's assets. And that could be knowledge, it could be IP, it could be email lists of a partner, it could be, hey, I partnered with Disney with my technology, and so now it's blowing up because I've got access to their market. So it's other people's assets, okay? And then the sort of next level outside of that is you start to stack assets. What do I mean by this? What I mean by this is, you start to acquire assets of value that theoretically are going to appreciate over time, probably by these things that are sort of, that you're creating with your effort, right? So here's your effort. Now the thing is these are all of the things that are inside our control, and the sort of steps to creating value in the world. All right. Now, the thing is that let's talk about this a couple of different ways. Let me give you a few examples. Number one, you're an entrepreneur. Okay. You start by adding value. What's the pain I'm solving? What's the solution I have? Let's create a business around it. Let's go. Then you start to raise capital by leveraging other people's money. You start to bring on employees by leveraging other people's time. Okay. You start to create IP and all the rest of it, and maybe you start to leverage other people's assets, like you sell your product on Amazon, for example, or you sell your product into Walmart, and you're leveraging the expansiveness of their asset in order to get your business going. Okay, then over time you're going to start growing through acquisition, like all good companies do. Amazon bought Whole Foods, et cetera, right? Like all successful companies ultimately start growing through acquisition, because acquisition is equally as important as innovation, as expressed in this graph. And so these are the things that are within our control. And so you add value, you go get a job, okay? You go get a job. you take a bank loan to buy a house and then you start to stack assets, or you leverage other people's knowledge by hiring a financial advisor and investing in the stock market, okay, or whatever it is that you're doing. And then, or through acquisition, you're adding value at the core. You are the CEO. You're pulling the deal together. You're finding the deal. You're putting in time. You're figuring out how it's going to create value to its customers, all the rest of it. You go get a bank loan, okay, other people's leverage, okay, and you find that asset, which is in other people's time, which is the business that you're buying, okay, other people's knowledge, other people's, your employees' time, the assets that are created in that business, and then you start to stack assets on top of that, by acquiring that first business, okay? Now, here's the thing. Where does risk come in? Nothing in here is risky. This is just your execution, okay? This is just your execution. Risk comes in on the outside, okay? And this is the external markets. The external market, the economy, it's everything outside your control, all right? And the external economy can make your efforts and the value of your assets rescind, okay, or expand, okay? And, in my 25 years of adult life, I would tell you that I've lived through 2 major recessions, or I'll say two or three black swan events, major recessions, all the rest of it. And the thing is that you just have to continue to add value. You have to continue to take leverage at the appropriate ways, and you have to continue to stack assets. And so the way that you address this external market and the risk, okay, is through the things that you control, all right? And the things that you control is at its core your ability to add value. And the thing is that the greatest force that you have to break through this external risk factor is time. In other words, control over risk, okay, equals effort plus time. Said more succinctly, hustle every day for your entire career and use all of the things that are available at your disposal, and ultimately you will beat the external markets in terms of what it is that you're trying to accomplish, okay? So get out there and hustle is the lesson. All right, listen, if you want to buy a business in the next 6 to 24 months, we have built the premier acquisition accelerator at Acquisition Lab. We've got world-class education, diamond coaching method with multiple acquisition entrepreneur advisors. We've got resources, tools, and a vetted community at the end of the day. So look forward to seeing you on the inside. Thanks so much.